right, welcome everybody. Shane Carter here, Hampshire Capital. With me, as always, our VP of Investor Relations, Eddie Austin.
How are you, Shane?
I'm doing great this beautiful day. Eddie, how you doing, my man?
Man, it is a great day. It's a Monday, which, I'm not one of those Monday downer guys. Monday is just another day of the week, and it's a great day of the week.
It's a great day
I
to
get
kick
to
it
see
off.
my team again.
That's right.
Yeah.
So what are we talking about today, Eddie, on this episode?
So, we went and toured some properties last week. And when we did, just the general conversation when we were all together, we got to talking about, what vintage assets, what year assets do we buy? And I had a ton of emails that me and Nick had went through, and we were looking at different asset types, or not asset types, but different years of the assets and then submarkets. And then today we got a call about an asset that was in a Houston market, and you immediately said it was too old, and it just kind of sparked my attention of we should do a video on that. So what I want to do is go through multifamily, of course, and we look at value add. But for Dallas and in Houston, we got two different buy boxes. We got two different ones that we would buy. We wouldn't buy a 95 essentially in Houston, but we might in Dallas. So let's go through that.
Sure. Yeah, and I think let me just set the stage on that in general. I think, as time moves on, we are going to continue to move our buy box, earlier and earlier in time as well. Later and later in time. You know what I mean? Newer and newer.
Yeah.
Because,
right.
it's crazy to think, right? But a 1990 asset is 33 years old now.
Mm-hmm.
Right? And
I remember, I know you will. So when you first started buying assets and when I first started buying assets, we were looking at assets that you had to worry about lead-based paint.
Sure.
You had to worry about lead pipes.
Mm-hmm.
Not many people's dealt with that before, but lead pipes.
Yep.
Aluminum wiring or knob and tube wiring, which was extremely dangerous.
Oh yeah, asbestos and all kinds of fun things go on in old properties.
Yeah.
And so that's the number one. That's one of the main reasons, which is that as we've moved on through the years, the codes have improved, the building materials have improved. You don't have cast iron pipes under the ground like you did, back in the 60s, 70s, and even sometimes in the 80s. You don't have aluminum wiring. You don't have any of those issues in older properties. You don't have chiller systems, and
Right.
You just have more modern HVAC, plumbing, electrical, the infrastructure of the property, the subsurface drainage, and even generally speaking, how the site work was done, how the foundations were done, the soil conditions, the backfill, the drainage, all of that has continued to get better as we've gone through the years, as the codes have improved, and as building technology has improved. So that's one of the main reasons that we look to continue to upgrade our assets into newer and newer vintages.
Mm-hmm. And you talked about codes, and I want to touch on this real quick too, because I opened some panels in Dallas, and they were all normal breakers. So, there was a lot of cost involved in older properties to, getting rid of the lead pipes and the aluminum wiring and stuff like that. So the value add essentially was pretty expensive. And now you're looking into certain states are getting better for us, more cost effective on us to value add properties. But there's a caveat to that. If you are buying properties in Kentucky and it is a newer property, say in the 90s, maybe in 2000s property, you have to pay attention to the electrical code, because as the codes now get better and better and improve, now they're starting to cost money on certain aspects. Electrical breakers for one. Mm-hmm. So if you buy an asset today and it's in Kentucky and you are renovating, so if you pull wire, so if you have to pull any kind of wire in anywhere, if you're going to put a new plug in somewhere inside that unit, because it's, say you're going to put in a trash disposal, so you're going to have to pull a wire. So you have to pull a permit. When you pull a permit, they make you adopt the code. So whatever that code states. Well, currently that code is going to a 2022, and 2022 says that you have to have GFI breakers, arc fault and GFI breakers even 2 poles.
Mm-hmm.
So you're talking about a $15 to $34 breaker for every panel and every unit.
Yeah, that adds up.
That add up real fast. So it won't take long before your business plan becomes very expensive.
Mm-hmm.
So just something to think about.
Yeah, that's it. That's another good reason to continue to get into newer and newer vintages is less and less of those issues. But then the other part of it, Eddie, is really we do value add and we do look to improve operations, and oftentimes that includes a little bit of a change in the resident profile in the tenant mix. And that's, generally speaking, easier to achieve in a newer, more modern property. In other words, if we buy a 2002 asset that is 21 years old now, right? And there's a lot of value add that can happen, and we go in and we renovate it and we bring it up to modern standards, modern finishes, but we still price it to be substantially below new construction and new deliverables in the market. Well, now we have a really interesting story. And we can oftentimes achieve that at a substantial discount to new construction pricing. So we have a great basis, we have a great rent growth story, and we have a great pro forma rent story that is, again, substantially below the market for the A-class product. And in general, that's reasonable and achievable because you have higher ceiling heights, in these newer products. Mm-hmm. The amenity, there's either amenity packages in place, or we can renovate and amend the amenity package to feel and look more like a new modern asset. Mm-hmm. And again, the resident profile is already sort of in a different profile where it's not as challenging to manage that. And it's a little more easy to manage that resident changeover from an asset like that versus, let's say, a 70s or 80s asset in a workforce housing pocket that, you can improve the asset, but the resident profile is essentially not going to change very, very much.
Right, 100%. And I can, as a laughing point here, your renovation team will love you for buying a property that doesn't have plastered walls.
Yeah, that's right. Yeah, for sure.
Stucco and plastered. Anybody that's put a can light through a ceiling that had plaster on it, that had the wire inside there, you're cussing. Yeah. It's not fun.
No, that's no fun at all. And then really the sort of third leg of the stool, if you will, on this is frankly a lot of our equity, right? And institutional equity and equity groups and family offices. They're also looking to really invest in more of a flight to quality type product. Yeah. And, sure, we won't be able to deliver those outsized, high teen, low 20 returns on an asset like that, but it's safer. It's an easier management lift. It's an easier CapEx lift. It's an easier resident profile lift. And in general, you're going to have, a much stickier rent roll, fewer issues relative to bad debt and AP issues. And so it's just overall a safer investment, if you will, in a newer vintage product.
Yeah, absolutely. Yeah, absolutely. For sure. So, to leave people with kind of, to bring it all into focus, for new investors and for people that are buyers, sponsors, the things to look at is the MSA, really look at the demographics of everything. And then pay attention because just because it's Texas has got tons of submarkets. So really understanding that submarket, and then the way construction was built, what time frames bring up what flags, and then look at the codes, the different things, and understanding the full business model all the way through, from what kind of things you're going to have to mitigate, what things you're going to have to put into place because code tells you have to. All those types of things can make a successful operator or bring successful returns to investors.
Yeah, that's absolutely right. And I'll just take it a step further is that, not everywhere in Texas is a good place to invest, and Dallas is a great place to invest, but not everywhere in Dallas. So you got to drill it down into those neighborhoods within those submarkets, really, and really drill into that hyper localized level of what's happening there, and what are those, median household incomes, job growth, pop growth in that particular neighborhood within that submarket, and that's really kind of where the golden recipe is, so to speak. And then we look for underperforming assets and so on and so forth to implement a value add plan. But yeah, the reason we're still open to, let's say, 80s vintage in Dallas is because of how resilient that market is and how much product there is in that market. So we know that if we're taking something that is the very 25th percentile of that submarket and raising it up into that 75th percentile, we know that there's a sort of liquidity component to that investment where we know we're going to be able to trade that out in 3 to 5 years and get the returns that our investors are looking for, without too much headache, stress, or hassle. Dallas is always going to be a great place to buy and sell, and the sheer quantities of it are what make it attractive to us. As opposed to, Houston is a little more, it can fall prey to some of the fluctuations in the market, especially the energy market. And it's just a little bit more cyclical and has a little bit less resilience than the Dallas market, which is why also we love a lot of the Florida markets, because, net immigration just sort of solves for a lot of problems, right? In a local economy for multifamily. And my goodness, there's just, there's 1,000 people a day that move to Florida, and Florida can't build enough product fast enough.
No.
And so you still have this severe supply demand imbalance that is a huge tailwind to the multifamily industry.
Mm-hmm. The last thing I'll touch on here is, and we all agreed to this, we're all driving around looking at properties, and the feel you get when you go onto an asset. And with that, we're not going to buy or own anything or even put in an offer on something that we don't feel good about owning.
Yeah.
And that comes down to not only just the pride value of buying that asset. It's not a trophy. It's not for that sense. It's knowing that we would own this piece of property, that we'd be proud to have it on our website. Mm-hmm. And then also that it is a nice place for tenants. Like, we would live there ourselves. Mm-hmm. This is a really nice piece of property. We would take our kids there. We would go there. One of the places, I would even fish there. I mean, I would be looking for a place to stay because I go fish.
Yeah.
And those types of things. So, all you guys out here that are guys and gals that are looking at purchasing properties or investing in properties is having that feeling when you get on the property and it feels good. It's a little easier to build the story then.
That's right. Yeah, 100%. And frankly, that's why we just flew to Dallas, and that's why we're, flying to Florida in another week. And that's why we physically continue to go to these locations, because there's only so much you can see on Google Earth. And when you get there and you physically see an area and see an asset, it's that it's that feel. And that's what we're looking for, is understanding how does it feel? What are the comps like? We tour all the comps. We understand what's going on in the submarket. What's the competitive advantage? What's unique about our property? Why would somebody choose to live there versus somewhere else? And what's the opportunity, right? And you really need to physically go there to get all that.
Yeah, 100%.
Yeah.
No, it's so true. Hopefully, investors and sponsors that are larger and smaller, hopefully this podcast is something you can take a piece out of, or again, like we said on the past couple, if there's an idea you have or something that we've missed that you would like us to do a video on, please reach out, because, we've built us a list of videos that we're going to start with. We're going down through that list pretty quick, and there's always something that we've missed. And this episode here, it didn't come to me till today. This was added to the list. Mm-hmm. We should do a video on that, because it's something that we have an appetite for certain years of properties in different neighborhoods and in different cities.
That's right.
So we should probably do a video. So here we are today doing this.
Yeah.
So again, guys, gals, please like and subscribe to the channel. And please, by all means, leave us some comments. good content, bad content, lighting sucked, Eddie needs a different color shirt, anything, anything. Just, comment, tell us what you would like to hear next. Maybe you want us to go more in depth on a certain subject. Maybe we've hit some high points in these videos. Could you really dive into it? We would love to.
That's right. Well, hopefully this episode was valuable and people got some good insights from it. And
Yes.
yeah, we'll look forward to doing the next one with you here.
Absolutely. Have a good day, Shane.
All right, buddy. You too.